Hi, my name is Denise Modersky. I'm a tax director in our state and local tax team out of Metro Park, New Jersey. I'm here with my colleague, Andrew Cohen, senior manager in our group, and we are going to present a state and local tax, PTET, and domicile opportunities. So what is PTET? This has been a very interesting area, right? Like Andrew, we have been dealing, we have been constantly busy, getting a ton of questions. This is a highly valuable opportunity for our clients and our group, and I think it's important to kind of bring awareness of how we can identify these opportunities, how can we work together and kind of identifying and helping our clients with PTET. So what is really the PTET, right? It's a federal benefit, really, in short, it's a federal benefit where in 2017, TCJA imposed a $10,000 limitation at the individual level for state and local income tax deduction for federal purposes. So with PTET, what happened is that Connecticut was the first state that came out with a mandatory PTET, which is an entity level tax. So basically you're shifting that individual limitation, right, the deduction from the individual to an entity, either a pass-through entity or an S corporation, and they're not limited to $10,000. So that's something that you get to fully utilize, take the full deduction, and that gets passed through the members, to your individual members, whether they're New York residents, New Jersey, or whatever state there is. So that is highly valuable, right? Because you are you're getting rid of the $10,000 limitation, which it's a burden for taxpayers that live in high tax jurisdiction. Like you in New York, right. I live in New Jersey. We pay well over $10,000 in real estate taxes, right? And that's not even including our state income tax and local taxes. So you can only imagine this $10,000, like what of impact it created to taxpayers in those states. So that's really the PTET. And Andrew, would you like to talk about like some of the benefits that you have seen?
Yeah, first of all, there was concern when it first came out whether the IRS will allow the deduction. Mm-hmm. And that was a big topic. And eventually the IRS issued this notice 2020-75, which said they're going to pass these regulations, which hasn't come out yet, but hopefully one day it comes out, that will allow the deduction. Mm-hmm. And that opened the doors for all the states to have a pass-through entity tax. Since that time, there's now 36 states that have a pass-through entity tax. And there's only...
In the city.
In the city too, New York City, yes. Don't forget New York City. And there's only 6 states right now that doesn't have pass-through, that has income tax, doesn't have it. Mm-hmm. 3 of those states, Pennsylvania, Vermont, and Maine, have legislation to pass a statute. So soon, all the states will have this pass-through entity deduction.
So people can only imagine how busy our team is going to be. We don't have 50 people, but there are 50 states, so that's something to keep in mind.
And these states come out guidance every single week. There's something new that comes out that you have to keep track of. So.
Yeah, and there are so many nuances with PTET. As Andrew mentioned, there are 36 states. Something to keep in mind is that there is no uniformity among the states, right? So every state have their own rules, different due dates, different forms, different requirements, eligibility, and whatnot. So we do have a chart, a tool that we have our team put together, and we highly update that frequently, right, for all the state changes. So something to keep in mind that we can use to help you at least identify what states have a PTET, what are the due dates, what are the forms, the estimates are required, and whatnot. But I think with PTET, like some of the key areas, right, benefits that you mentioned, the federal deduction, right? You want to talk about that a little bit more? Like how does this create a benefit?
Right, yeah, exactly. So originally when you have partnerships like an S corporation, an LLC, the income deductions flow to the partners, the shareholders and members, and they pay the tax. Here they kind of switch things up when now they say the entity pays the tax on the income. Mm-hmm. And the amount of tax that they pay is a deduction on the federal return. And the main benefit is going to be, we tell our clients, the highest tax rate, which is now 37%, multiplied by the deduction you take on the return. So for example, say a client takes a $100,000 deduction on the federal return. That's a $37,000 benefit that they wouldn't have if they didn't make the election. The other benefits is that on the individual partner shareholder level, they get either a credit on their state return for the taxes paid on their behalf, or they get a reduction of income. 8 states have reduction of income, meaning that the K-1 income flows to that particular person is reduced by the amount of taxes paid on their behalf.
Yeah, and also to factor that in, to include into that, it's that if we have taxpayers that sell a business asset or they have in disposition of a partnership interest, that generally creates a significant capital gain. And those are transactions that could create a large benefit from a PTET standpoint. So something to consider, right? Like if you don't know what your income is going to be like, and you expect, and you end up having a large transaction, there could be a huge benefit created from that.
Right.
Right. I mean, like, think about a taxpayer, right? They're going to be subject at 37% federal tax rate. By having this PTET in place, they are obviously limited and they could end up being in a lower bracket. So something to definitely consider as, especially during this time of the year when we're all working on year-end planning opportunities.
Right, exactly.
So
you also have to be cautious of the election dates.
Mm-hmm.
Right now, 35 states have an elective. You have to elect into it every single year. There are a few states where it's not yearly, but for the most part, it's yearly elections.
Mm-hmm.
And if you miss the election date, you can't make the election. You lose. There's no late elections allowed.
Yeah, and we have seen that in New York State a lot, where taxpayers have uncertainty of what their income activity will look like at the end of the year, so they don't make an election, and then it turns out they have a large gain, and they cannot go back and make an election. New York does not allow for a late election. So to the extent that you have this scenario or this situation, make the election. Always recommend your clients make the election. And worst case scenario, if you end up at a loss or you don't end up having significant income, at least then, the election is in. Right? It's better to have it in as opposed to not being able to go back and retroactively apply it in an election, especially because this impacts the taxpayers, right? All the individual taxpayers that are going to be picking up the tax.
Right, and if say you do pay estimated taxes for the year and you don't have an income at the end of the year, you get a refund, that's all.
Mm-hmm.
You get the money back.
Exactly.
There's no loss.
Exactly. And another benefit of this is that by making this PTET, the entity is taking the payment at their level, so you don't have the individuals making a separate quarterly estimate, right? There may be different rules for certain states, but overall, you do kind of move the responsibility for an individual taxpayer. And if taxpayers are like me, I tend to forget things, so it's kind of hard to to keep track of all the estimates that you have to make for every state. So having the entity make that for you, then it definitely creates a benefit. It's a relief. Other things we should talk about, it's California, right? We have seen this with California. It's one of those special states where if you don't you have time to make an election by the due date of the return, which is March 15 or by an extended due date, which is October 15. However, if you don't meet the requirement of a prepayment by the second quarter, which is June 15, California will not validate a PTET election.
Right.
And we have seen that, right? I mean, we're dealing with clients right now. We're like, well, I made it by 3/15, but they didn't make the payment. So that could be detrimental to investors.
And you have to pay the right amount. The right amount in California is the greater of 50% of last year's tax, PTET tax, or $1,000.
Right. And the 50% would only apply if you made an election in the prior year.
Right.
So as you can see, right, California has their own rules. New York has their own rules. You have to do it by 3/15. There are just so many complexities that comes into PTET and other things we're talking about, obviously, all the PTET general guidelines, but there are other things that impact PTET as well. Sourcing, the type of entities we're dealing with. Are we talking about a pass-through entity? It's an S corporation. I mean, we've seen this, right? Like, for example, it may make sense to do a PTET for an S corp, right? Where in certain cases versus a pass-through entity. So those are things that we have to look at it from a planning standpoint. Is do we want to have an S corporation form, or is it a pass-through entity? Like, who are the investors? What type of investors? How do we want to create a structure, the entity that where we can get the most benefit out of the PTET?
Right.
Right.
And also New Jersey's got special rules you have to follow too as well. The election in New Jersey is due with the extended due date of the return. However, you have to make the election first to make a PTET payment. Mm-hmm. So even though they tell you can wait to the end, you kind of have to make the election right away if you know you want to make the
That's right. And the same thing we have with Massachusetts. You have to you make it with the return, but there are quarterly estimates. And before you do quarterly estimates, you have to create an account on the Mass Tax Connect. So you do have to do some of the steps, even though it tells you by a certain date, you have to do it prior to that. So it's something to keep in mind. Other states, for example, require registrations, like New Jersey, right. Mass. I believe Ohio, it's another one that you have to have a registration. So by having a registration, people tend to forget, okay, I made an election in year 1, I don't want to make it in year 2. But since you are registered with the state, there is technically a filing requirement. So things from the next standpoint, it may also be created because of PTET. So again, they're all commingled with each other, right? You have sourcing, analysis that go into place, apportionment, entity structures, PTET. It's a very complex area. So the point we want to drive here is that it requires a special consideration, and it should not be assumed that one state's rule applies to the other. So it's highly important to know that we have the resources in our team. Most of us have dealt with PTET, and it's a great opportunity to kind of get the team involved and work with your clients, have these conversations earlier on and for planning purposes.
And we can advise our clients what to do. We've been...
Exactly.
Yeah.
Yes. So that's on PTT. Another thing we want to also bring up, it's a very valuable area, which we have dealing with, and we deal with, is audit defense, right, with residency issues, right? Domicile or statutory residency. Especially with COVID, we had New York City had so many taxpayers like flee the state, right? They go to Florida. Where do they go? States where they don't have personal income tax. Texas, Florida. New York State, well, say, oh, well, look at you. You're going to a state where you're not going to pay any tax. So guess what? We're going to audit you. So this is where domicile and residency issues come up and we deal with. So Andrew, care to talk about some of this domicile residency? So
domicile is the place where you spend your permanent home in, where say you leave and you come back to you, that's your domicile. You only have one domicile, and that domicile is yours until you actually change it. And to change it, you have to land in another state or land somewhere else. So you have to physically leave New York and land in, say, Florida. That is going to be your change of domicile. And so some of the things you want to do to make sure you change your domicile is to really show the state, New York, that you did change your domicile. For example, stuff that's near and dear to you, take with you to Florida, like your furniture or your dog, or change your driver's license to the new state, register to vote in that new state, or get the exemptions. For Florida has a homestead exemption. Make sure you get the homestead exemption done. Change your lifestyle so that all your holidays are spent in a new state. Your work activities in that new state.
I mean, things like your primary physician, right? Make sure you change that. Your living will, things like that. That on a day-to-day basis or normal basis, voter registrations, you want to establish. The more steps you take on, the better chances you have to defend your position, whether you are a New York State resident or not resident.
Right, because it's the taxpayer's burden to actually establish a change domicile.
Exactly.
And also, there's something called statutory residency. You mentioned statutory residency. So even though you take all the effort to change your domicile, the state can still say we're taxing all your income because you're a statutory resident. And that happens when you still have a place in New York State or New York City, like in an apartment, and you go to that apartment more than 183 days during the year. They can say, well, you have a place of abode, you can go there, you have access to it, you've been there more than 183 days, you're really a New York State resident still.
Yeah, and also you mentioned, right, you can only have one domicile, but you can have more than one residence, right? Tax residence. So you could still be considered a New York resident, even though you may think you are a Florida resident, you can still be considered a New York resident if you don't take the appropriate actions, the appropriate steps to establish out-of-state residency.
Right, so to defend an audit, you want to make sure you have a calendar close in time to when things happen. Because contemporaneous calendars does not help in an audit. So you want to have an Outlook calendar, you want to have somebody take track of your days so you know exactly where you were on a particular day. Yeah,
I mean, nowadays there are so many apps that people can use, right? People can use and track their days. I mean, you'll be surprised. There's so many apps and features that you can do and there are companies there that will even track your days to make sure that you're not like overpassing the amount of days that it could trigger a residency. So the point here is that it is a complex area and it is highly valuable. Our clients may not be aware, or may not have the time to be involved in all these planning opportunities, which they come to us and rely on us for this support. So we do have the expertise, and we have the resources to help with this type of opportunities, and it would highly suggest that people take advantage of that.
Right. Just give us a call. We'll help you out.
Always available if anybody has any questions. We're happy to participate in year-end planning opportunities or discussions with clients or prospects or whatever it need be. We have the right resources and the team available.
We have a good team. Yeah.
Correct.
Yeah.
So with all that said, we want to thank everyone for your time and hope you found this video helpful. And we're always here to help.
We'll hear from you soon.
Thank you.
Bye-bye.